You are live. There is such a lag right now going live. Oh my God, there's such a lag. Can you guys hear me? Lag, lag, lag. Hello, hello, hello. Woo, there is a lag. Anyone hear me? Oh, you see? Audio. I'm going to have to come and log on again, guys, because the lag here is way too. Hello, hello. No, no. No, no, no. Yo, what's up? What's up, Brian? There's guys. William, I can hear you. Yeah, but do you hear me? Like, am I lagging? I look like I'm lagging. Nancy, we can hear you. Okay. Yeah, Jay can hear you. I can hear you. Yeah, but can you, the way I'm moving, am I moving like a robot? No? Yes? Small video, but the video is very choppy. You see, that's what I'm saying. You are good, Victor. This is what's happening with the Rona. Everybody's home. Everybody's home with the Rona. And it's not letting me see anything. Look like you are pop locking. Yeah, pop. Stupid ass. Pop locking. Pop locking. Pop locking. Drop it. Pop lock. Remember that song? Oh man. Listen. Hey, listen. You guys are here for the voice. You're not here to see me anyways. Anyways, let me get my partner John on the line. We had a rough day today.
Hello.
John, what's going on?
Hey, what's up?
Over here, I'm very choppy here on YouTube and on Facebook. I guess there's so many people online right now that the video screen is very choppy, but people can hear me loud and clear on YouTube and on on Facebook.
Wait, what is that? There's so many people. What?
There's so many people at home on YouTube that the screen, when you do a live video, the video lags. It has like a lag in the back.
Oh, that's interesting.
Yeah. Well, anyways, we're here to talk. Yes, lagging. You good, man? All right, cool. So as long as you guys can hear us, that's all really that matters. But if my voice is choppy, then that will be bad. So let me know if my voice is coming through good, or if it's choppy, like staticky.
Yeah, the voice. Yeah,
yeah, right.
The voice is important. Yeah, the voice is important, obviously. So I mean, even if the visual is tough, obviously.
And if you can hear John too, let me know. YouTube. Go on the video and press like, so I know if we're good. Voice is cool. Voice is clear. Okay, great. All right, somebody else is calling me. 317 area code, Indiana, John. Busy day, John.
Yeah, good day.
It's been a good day because we had a customer complain and they were looking at Credit Karma, and because of that damn Credit Karma, we were able to get the situation straight out. So
no, but there's more to that. There's more to that. That story that's a long story. That the person that complained, they didn't even pay for the service. The sister paid for it, which was our point of contact. This guy came out of nowhere, and I mean,
That's what happens when you are not involved in the credit repair process. When you have someone else pay, and that has been the big problem with people who want to send us business, where they want to pay for the service, but then they want to be in contact with the customer. We don't want to do that. And the last 10 years, we've tried everything out to do it this way, to do that way. It's best if we take care of you and are in contact with you than having to go through a mediator or whatever.
Yeah, I mean, in this particular case, it was a very confused individual who was being helped exponentially and didn't realize it, and didn't even realize the one account we were retained to remove had been removed from the bureau he was concerned about. He was very confused, and we had to unconfuse him. So all is well that ended well, so it was fine, and obviously we did what we were supposed to do, and it just took a little bit of explanation, and obviously the deletion, the removal sheet of the deletion itself obviously helped to alleviate some of that confusion. But
correct.
All in all, it was a good day.
We shut him down because he was wrong, and let's just say that could be another video on its own. But we have
listen. It's more about just the way we operate. It's we're real big on as anybody is. I mean, you give respect, you get respect in return, right? And there was a little bit of a miscommunication early on that needed to be clarified in regards to understanding what it means to be respectful to people and how you communicate with them, even when you're not wrong, right? But especially when you're wrong, and you're absolutely wrong.
But also people think that they're like talking to me, like I on YouTube, on Facebook, on Instagram, I come across as this nice guy and everything, right? And there's some people just feel like they could take advantage of like talking to me a certain way.
No, I honestly listen. I don't think it's about you. I just think.
But it was only one. It was only one out of how many times? I mean, this doesn't happen.
No, it's not. Listen, it's not common. And at the end of the day, things like this happen. I mean, even if you're hitting 975, there's going to be a pitch or two that you miss. And even in this case, like I said, I mean, it was a situation where the client came very confused and very, very, very confused about what he was reading and referencing, etc. Just conversation, you get them back on a page. But at the end of the day, I mean, it happens sometimes. I think the thing that was more frustrating was the initial email, and we're big on respect. We're big on giving respect. We're big on getting people to their goals. We're big on a lot of things. And this guy was not the individual. His sister paid for him because the situation happened, and we were dealing with the sister, and he came out of nowhere, even though we were helping him. We asked to speak to him originally, and it was just very kind of hands off. And then we're not even done the first round, even though we cleaned it off. One of the bureaus already, and we're waiting to get another one. But it was just, look, all is well that ends well. So the individual understands very clearly with zero deviation now, and his report is where what that his sister hired us to do for him, which is fine. And stuff like this happens. It's in any line of work. So there's occasionally is miscommunication, and in this case, this is why we talk about all the time about trying to eliminate a lot of the misinformation that exists, and we try to make these videos to educate people so they understand what they're looking at. This particular individual, we might as well just segue it here. It was somebody that was absolutely adamant about thinking Credit Karma was the end-all be-all monitoring site that exists. And unfortunately, I mean, we've talked about this in previous cases, there's just a lot of confusion surrounding it.
Correct.
And with that in mind, it misleads a lot of people. And a lot of people, there's certain individuals that feel like they know everything, even though they know very little. And in certain situations, when you have a coupling of that with that particular site, it causes disruption and a lot of confusion. I think for anybody that doesn't do this for a living, it can be very confusing trying to understand the swings and scoring on the site like Credit Karma. And we've talked about it before, and it's just unnatural, and it really concerns people. And
I think we should have a video on that, John, because everyone is crazy about free this, free that.
Yeah.
You know what I'm saying? They go to
But here's the irony, though, right? Not to interrupt you, but here's the irony. Experian offers a free report now. Equifax, my Equifax is completely free. TransUnion, I mean, the dispute portal is free. There's no score involved, but these are all free reports you can get directly from the bureaus where you're getting the information directly. Now, I know everybody out there, it doesn't matter who it is consumed by the score, not realizing that the score is a lagging indicator to the report, right? Because that's what it is. The score is a lag to the report. It follows the report. So as you remove accounts, the score goes up. The score doesn't lead the report. The report. The report leads the score. So, I mean, people get so consumed by teasing the score with AUs and things like that. Even though their score, the report may have 6 or 7 negatives, they're like, yeah, I'm at a 650. I'm not that bad. I should be able to get this. No, man. The report is what the algos are reading when you're applying for a credit card. The report is what the mortgage company's looking at, the lender's looking at. You know, when the score gets you in the door, it can give you some type of some type of legitimacy. But the reality is, the report itself is what's important. And all these different monitoring sites like Credit Karma and ScoreSense and these credit card scoring sites, which are horrific, right? I mean, they're Credit Karma level. Okay. They're so misleading and they cause so much confusion to people, and it just screws them up. Like this particular individual, just to reference again, was jumping around from Credit Karma to his Chase site to my Equifax and trying to compare apples to oranges to pears to grapes, and none of it even made any sense to begin with. But at the end of the day, you can't do that, right? If you're going to measure against a site, that particular site, regardless of what it is using a particular type of formula. That formula will deviate in all likelihood from a different site. For instance, Experian uses a FICO-based site. That's, more than likely that site's going to be correlating to, a mortgage pool because it's a FICO site. So it's going to be similar to what you would see if you went for a mortgage pool. It's going to deviate, though, when you go to an auto pool because they're using a different formula, and a credit card pool because they're using a different formula. And then those particular creditors merge it with their internal information on you as well. So it's not a true credit card score. So, I mean, there's so many deviations here that you should just let, if you're going to pay, now granted, this was different because his sister paid for it, without continuing to go back, but speaking generally now, if you're going to pay a professional and you truly trust the professional that you're hiring to do it, you need to, you need to lean on them to ask these questions, because part of this process, at least on our end, is educating people at the same time on exactly what's being done and what the right way to do it going forward is, because we'll position you properly, but it's also equally as important for you to walk away with a profound amount of knowledge so that you don't make some of the same mistakes, right? I mean, and you're not doing the same thing twice, at least in a negative fashion. So, and another thing that goes on along with the misinformation around some of these sites and stuff is what we wanted to talk about today, which was about what creditors pull what bureaus, right?
Correct. No, not what creditors pull what bureaus. We're going to talk about what mortgage companies pull, what car loans pull, as far as bureau. Not bureau, because that is in the credit card funding system, but what bank pull what bureaus? Is that what it is?
It's fine though, but I mean, we can deviate. We can just run with it. So as far as
because we get that question asked all the time. Like a realtor on Facebook asked everyone, how many bureaus do banks pull when you do a mortgage? So that's a question that everybody chimes in, and everyone has something to say. But everyone knows that they look at the FICO score. But not a lot of people know that information. That's why we're here educating you guys. And that's why John here is the expert. And we'll get into it. And if you have any questions, please write them down. I'm going to get to all your questions once we finish with our train of thought first. And then we go into questions. If you allow me to do that, thank you so much. We got about 25 people on YouTube right now. And they're waiting for you, John.
Right. So the mortgage pulls, as a point of comparison, the only way you can establish a FICO score, well, not the only way, but in a typical circumstance, the FICO is the middle of the 3 scores. So you have 3 bureaus, they pull 3 scores. The middle score is if you pull all 3, is the middle score, right? We did a mortgage related, early on in our cast process, we did a mortgage related one, but I'm not going back over it. So the FICO is the middle of the 3 scores if you pull all 3 bureaus. If you're using the lender only pulls 2 bureaus, they use the lower of the 2. So that would be your established.
John, if you could have the phone by your mouth so that it sounds like you're kind of mumbling.
Okay.
Okay.
So as far as the mortgage is concerned, in almost every situation, in order to establish a FICO score, you need to pull all three bureaus. The FICO score is the middle of the three scores. Can you hear me clearly? Is that clear?
I hear you perfect. And
Okay.
once you finish with the mortgage stuff, I have something to ask you.
Okay. So the FICO is the middle of the three score. Is the middle score of the three scores. So if your Equifax is 720, your Experian is a 680, and your TransUnion is a 710, your FICO in that instance is going to be a 710, right? They're going to review when going through the mortgage process. They're going to review all three bureaus, but the score that they're going to use as a point of reference is that. If they only pull two bureaus, they're going to use the lower of the two scores for some reason. It happens sometimes for any number of reasons. In large part, it's because people put the wrong address in when they're applying and they don't pull the third bureau. So if they only pull two, it'll be the lower score of the two. But if that happens, it shouldn't really happen. There should always be a third bureau unless you put a freeze on it. And if you didn't, it would be an address related issue. So just keep that in the back of your mind. But either way, when you're applying for a mortgage, they need to establish a FICO. When they establish that FICO, obviously that's what they're utilizing in an effort to be able to turn around and extend credit and do it and arrive at whatever conclusion. For instance, in FHA, that FICO minimum needs to be a 620. In almost every instance, VA is down to 580. Conventional typically nowadays is north of 680, and jumbo is the same way. So when it comes to different models and formulas, I know there's some confusion now around the new FICO, whatever it is, 9 or 10. I got a couple questions about that lately. I understand something, and I explained this to a client earlier in the week. Fair Isaac is a publicly traded company. FICO is Fair Isaac Corporation, right? That's the acronym for it. So if Fair Isaac is a publicly traded company, it's a for-profit company. So every year they come out with a new FICO, and every year they do press releases around it, and you see it. They populate it in all the credit boards, and they get all the press releases they can in order to do it. But that doesn't mean it gets adopted. Go back and look at the last two, the 8, the FICO 8, FICO 7.
Yes.
Nobody used them. Nobody used them. You got to understand, they're a for-profit business. This is how they make money. Matter of fact, they're in huge litigation right now against the Vantage scores, which the bureaus came up with directly because the bureaus don't want to pay them anymore. They want to come up with their own scoring model and not have to pay Fair Isaac. So they've been litigating. You guys can look this up. They've been litigating for 3 years now about it, about that fact. So just because you see a new FICO scoring model be invented does not mean that immediately gets adopted and it gets adopted by all the different lenders out there and they're all like, wow, yeah, we need the next best thing. No. First of all, there's so many different formulas that get utilized both on the mortgage side, the auto side, the credit card side, etc., the personal loan side. They're all different formulas. So just because one new deviation of that came out does not mean it's autonomously adopted and then that's just the one for that year. Again, I implore anybody that has that question to go back to the FICO 8, FICO 7. Go back all the way down to FICO 1. I mean, you'll see that the deviations that they add each year hold no weight. And they hold no water. And in most cases, they don't ever get adopted because the lenders use the formulas that they're comfortable with. It doesn't always necessarily mean that formula is the one that FICO just came out with that's cutting edge because it's like a sequel for them, right? It's like a video game. Every year they come out with a new one. Doesn't mean the next one is the best one. It just means they're coming out because they need to make money, right? And in these situations, it's no different. So there's no different scoring model. I mean, I've been dealing on obviously in business for a long time and found that the formulas, you're not going to see, even if there is one formula from the next, on the FICO side, there's not going to be that much deviation in the actual score itself, whether there's negative accounts or not, because the FICO, as a generality, a FICO-based formula puts similar amounts of pressure on the same areas, right? So the only thing that is specified for a FICO coming out with is going to take a little bit away from one area and add a little bit more to another area. But generally speaking, broad swath, they're going to look almost identical, minus a little tweak, right? So it's not that much of a change. So I think people get all bogged down in all these technicalities because they become these credit board, myths that just get percolated, and then it just grows and grows and grows, and it goes from a little fire to this giant flame of percolation that everybody assumes is going to be the case. Unfortunately, it's just not. So, when it comes to, like I said before, I mean, when it comes to mortgages, I wouldn't expect any change in the in the scoring or any deviation, any great deviation from that. Even if they, again, I don't even want to go into any further detail than that because, like I said, anybody that's concerned about FICO 10, check out 9 and 8. See how crazy, how well they were adopted, across the industry, and you guys will get a much better idea.
Correct. Okay, John. So my question to you with the mortgage side is, how many accounts do you need to have in order to get a mortgage? I know we probably touched this in the cast that when we first started, but initially, do you think 3, 4 accounts?
Yeah, I think the FHA conventional requirement is 3 active accounts, I believe, and it deviates every year that it updates. Every year that rolls over, FHA updates and tweaks, their requirements. It was previously 2, I believe it's 3 now, with a certain degree of seasoning. It might be like 6 months, something like that. As far as open active accounts that you need to have primary, right? Where you're not leveraged off somebody else, where you're not piggybacking anywhere, but there's your primary accounts that open. So I can confirm that, but it deviates ever so slightly every year, but it's between 2 and 3. And honestly, the more overlays you have, which we talked about previously as well, an overlay is the further you get away from Wall Street. Obviously, Wall Street buys 90% of these mortgages, right? Wall Street meaning Fannie and Freddie, or these mortgage-backed securities where they take all these mortgages, they package them up together, and they sell them to investors, right? Correct. So the further you get away from that, meaning the further you get away from a direct lender or an actual lender, meaning a bank, they put overlays on it, meaning like a broker. If you go to a broker, which I don't even know if that's even still a business, but I hear people saying it sometimes. When you go to a broker, they get a lot of overlays because if anybody remembers back in 08, 09, a lot of the problems that existed in a lot of these bad mortgages were, I don't want to say all of it, but a lot of it was done through kind of inappropriate stated income reporting that was done at the broker level, right? Correct. So, and they also gouged a lot of unsuspecting. It was set up back in the day much like auto loans are set up now, unfortunately. That's how mortgages were done back in the day through brokers. And so the way that they basically hedge themselves is they basically said, look, the further you get away from us, meaning Wall Street, meaning we're going to add all these different these different things on top, meaning the credit score requirement has to be higher. So for obviously a direct lender or a lender themselves, FHA is 620. The further you go out, meaning to a broker, that may be 640, 645. They may have their FHA minimum may be that way because they're not trusted. You understand what I mean?
Yes.
And on top of that, they're going to be asked for more information than you would at a direct lender level. You ever wonder why Quicken Loans can pump out a loan in 3 weeks or 2 weeks and a typical broker might take 45, 50 days? It's because Quicken Loans is a heartbeat away, right, from Wall Street. They package all them bad boys up, sell them right together. And they have the ability because they have the trust and they have the confidence of Wall Street in order to be able to package these up, meet the requirements, get them turned over. Mm-hmm. So the further you go out, obviously, the more problem you have. So as far as the original question that you asked, which was I lost my train of thought. What was the original question? I'm trying to tie it back.
About
how many primary accounts?
Yes.
How many primary accounts? So the point of me going on that long digression was just to say it deviates every year, but at the same time, it would probably be like typically actives. It's like 2 to 3 active accounts that you need open for a mortgage. Now that's not like, just to be clear, unconventional mortgages like the ones that go like bank statement programs and stuff like that.
Yeah,
they do exist. They're different. It's a completely different underwriting guideline. Completely different investors buying them. And it's a completely different requirement. So that deviates, and I'm not even sure what that is because that changes almost on a monthly basis, some of those requirements, because the investors buying those mortgages change so regularly, right? So that's not as fixed and standard, but most people won't be using those mortgages, so I guess it doesn't really apply.
Okay. Okay, well, did you see in the news right now, Chase just raised their limits to 720% down?
That was actually yesterday. And you know what else Chase did? Chase also made a press release last Thursday where they stopped doing all business lending. It's discontinued indefinitely. They want to focus strictly on the PPP loan. So anybody trying to get a business loan with Chase has to wait until this is over, which is going to be a good 2-3 months because they want to focus strictly on it. So that's basically saying the biggest bank in the entire country and probably top couple in the world is now not doing any business loans for the foreseeable future. That's crazy. So, and if you go back, like I said, if you go back to, and I don't mean to keep referencing going back, but it's just encourage people to watch some of these previous casts because we talk about some of this stuff in a lot of depth. If you go back to early on when the coronavirus first hit, we did one of the, well, we're doing it every week, but it was early on. And I kind of played out to people kind of what to expect over the course of the next couple of months. And if you remember, for anybody that was listening then is listening again now, I'd said that, you know, you want to establish your credit now, right? You want to try and get it set up now because what's going to happen is as the economy contracts, you're going to start to see banks contract their balance sheets, right? They're going to start to get more conservative. Now, obviously, Chase turning around saying on conventional loans, they want 20% down and 700 score. That's effectively them saying, well, we want to limit the amount of applications we can get. We don't want to be inundated with applications, so we're going to raise the requirement. Everybody else will fall in line. Did the same thing in 08. Did the same thing in 08 and 09.
Well, people, you know, there's other brokers who are like, well, I could do the loan at 640. I just had something like that. I just posted that on my
No, but that's FHA. See what
FHA,
what you just read is, and again, 640. If a broker's saying 640, that means that goes back to what I just talked about, right? It's exactly what I just talked about. Where there's an overlay, they're talking FHA, but in reality, they can just, if you go to a lender, a direct lender, you can do 620. So they're not even doing anybody a favor at 640. But whatever the case may be, when it comes to all this stuff, the lenders, these are conventional loans they're describing, the 700 and the 20% down.
Correct. That's always been the case, though, right? It's always been 20% down.
No. There was Fannie and Freddie products that were 5% down.
Okay.
You could go conventional 5% down for sure. Yeah, you could do 10% down. Jumbo loans, anything over 5.25. The conventional loan limit, I believe, this year is 525. So anything over 5.25, you'd have to go jumbo, where they do like an 80-10, and then you'd have to put 10% down. So effectively, do an 80% one first, right, first position, and then you would take a second for 10% second. You'd have to come up with the other 10%. But they'd effectively, if you didn't want to come up with the full 20, they put you in a first and second mortgage to get in to only put down 10%. But in either case, in any instance, it's not uncommon that you're seeing them start to contract because it's understood. It's also not uncommon that they're going to continue to contract, and you're going to continue to see stuff like this go on over the next 6 to 9 to 12 months until some level of stability exists, and you start to see the economy start to expand again, and that could be a little while. So it's all as anticipated. If you go back in a lot of these casts, I know we harped on the coronavirus stuff for a while, and
correct,
we're trying to steer back into some of this credit stuff too, because obviously people need answers to this, and the coronavirus business stuff doesn't always apply to everybody. So we want to make sure we can kind of hit everybody with as much as we can. But this is all to be expected. It's nothing out of the ordinary. And again, I would think companies like Quicken and some of these really high volume lenders are probably going to do all right, because in all honesty, their investor is Fannie and Freddie, and Fannie and Freddie has to keep buying mortgages, right? They have to. That's the business that they're in. It allows our real estate sector to continue to grow, and it continues to turn over paper, which replenishes for the lender. But when you start getting into retail banks who are going to have to start to expose themselves in other areas of risk, you're going to start to see them contract. And as a result of that, you're going to start to see things tighten up, which is, again, totally expected. And it will continue to tighten up. This is just the first. Chase is the biggest bank. They're the first ones coming out with it, kind of letting everybody know, listen, this is what's to be expected and will continue to be expected. And the same will go for, you'll start to see the other ones fall in line.
But FHA is still the same thing, correct?
FHA is exactly the same thing. Again, keep in mind, FHA is a government subsidized loan. So when we have our government literally peppering the entire country with money and continuing to talk about more, it would be a little bit contradictory for them to turn around and start to shut off the faucet on the FHA loans, right? Cool. While they're still peppering everything else. So no, the FHA isn't going to change. I mean, look, could it change? Maybe. I doubt it, because they're one of the main drivers in our real estate sector and our economy, right? First time home buyers, primary residence buyers, you're backing out the investors. You're dealing with a different class of a different perspective, I would say, of buyers. So, and it encompasses a large degree of the sales that exist in our entire country. So, no, I don't see that changing. And honestly, if there is going to be a change, and I don't remember there being a change in 08, 09. I really don't. I think it was pretty much fixed. And as a matter of fact, I think it dropped down to this level in 08 or 09. They dropped the credit requirement, if I remember correctly, down to where we're at now. I think it used to be like a 660 or 650. I got to check on that. But I feel like back in 08, I think it was like 650 or 640, 650, something like that back then. And they actually dropped it as we were coming out of the other side of 09 to encourage people and to bring in more people to be able to buy, which again, real estate is a huge part of our overall economy, right?
Correct.
Every aspect of it, the construction, the sales, the realtors, everything, the appraisers.
The mortgage appraiser. Yeah.
It's
the
enormous. So it is a huge catalyst in our broader economy. So, I mean, they know how important it is to keep that humming, right? And knowing that the FHA, they're pretty much back, subsidizing all those loans. They know they can somehow control it to a certain degree. And by doing that, they're encouraging people to come out and buy. So, no, I don't foresee FHA changing. If anything, it'll probably become more accommodating over the course of time, depending on how this plays out. And the extent of the downside or the extent of how slow down the real estate market gets over the course of time, but I guess we'll just have to see. But no, that Chase stuff, that's more related to conventional loans.
Okay, so we have some questions. Can people still now? This is the question from the One Genesis Project. Okay, can people still now in the 11th hour still fix their credit to take advantage of the coming opportunities? Basically, is it too late?
No, it's not ever too late. I mean, it's not ever too late. I mean, honestly, I think, look, the one thing that needs to be understood is it's just not going to be as loose as it was before. I mean, they're going to tighten up. There's going to be a little bit more documentation needed, probably in some instances. They're going to tighten up a little bit. But those opportunities, understand, over the course of this next 6, 9, 12 months are going to become more bountiful, like we've been talking about, right? We're in the very, very early stages of a much broader process that's going to go on here, right?
Yes.
And I couldn't tell you the amount of times I've had this conversation with people over the last couple of weeks that maybe weren't around in 08, that maybe weren't around in 09, and every one of them is a little different. Don't misunderstand me. I'm not trying to say this is a replay of that, but the response is similar, right? The response is similar because you're basically repricing the entire economy, right? And in order to do that, certain things need to happen. And there's so many question marks. There's so many question marks relating to A, how we're opening back up, B, how many different jobs are going to come back, how many are going to be lost, which restaurants aren't going to be able to open up, et cetera, et cetera, et cetera, right? So on and so forth. That as a result of that, people know into the end of this year, I had early on said, the second quarter obviously was lost. The third quarter, originally I said, look, it's going to be a feeling out. We're just going to have to see how it plays out. And I think the third quarter is going to be lost. I think that if anything, we're looking more fourth quarter and into next year as a means of trying to find stability. So if that's the case, and you start seeing, for the people that listen to us each week, I like to say that, the stock market moves like a motorcycle, right? It zigs and zags, moves very quickly, but the real estate market moves like an aircraft carrier, right? It takes forever to turn around. And when it aims in that direction, it moves slowly, but it's committed to that direction. And the real estate market is exactly like that. And so you're going to start to see an unwinding. You're going to see a lot of things occur over the course of the next couple months, going into the end of the year. And as a result of that, you're going to see probably forced selling and a number of other things. I think there's going to be issues. And I don't want to get on a doom and gloom, but the reality is you're going to have people that literally bought the first quarter of this year in areas like Bergen County that are overpriced already, and other areas where they finance 96.
Bergen County is here in New Jersey, where I'm at.
Where things are trading, that it was such a buyer's demand for such a long period of time that things were trading way over what they were worth, and they were somehow getting the appraisals to work. The problem is that if you're somebody coming in there and you're buying FHA and you're buying 97, you're putting down 3.5%, you're 96.5% leverage before your closing costs, which are another 3%. So let's say you buy an $800,000 house, FHA, let's call it 600,000 FHA. You put down 18, but in essence, your closing costs are 30, right? Because they're about 5%. So even though you put down 18, you're still upside down in that. You're adding another 12 to the purchase price. Well, let's just say that price you overpaid by 10% in a real market. Well, chances are that you're going to see a correction in the real estate market of another 10. I mean, it could be more than that. But I mean, let's just say 10, 15%. So now effectively you're 20% from where you just bought when you thought you had a deal. 20% on 600,000 is 120 grand, right? And you're literally into it for 6 and change. So your house can be worth 480. Excuse me, and you're into it between the mortgage and the cash out of pocket. You're into it for over 6. And what people end up doing is they end up going, they're very short-sighted. They don't look at it in the big picture that it's going to rebound, because it will, and that's going to come back up, which it will, right? When things, improve. It might take some time, but it happens. And people turn around and they immediately want to go back to the bank and they want to negotiate. Well, my house isn't worth what it was worth 2 months ago. And this was inevitable, by the way. I mean, when you're lending this much at that high of a leverage rate at 96.5%, it was inevitable that prices were so frothy for so long in the real estate market that eventually a pullback was going to happen, that eventually the people that bought that high were going to get trapped, right?
Yes.
I mean, it's just, you hope that it's not the bulk of them, because a lot of people are going to have to figure out a way to unwind. And some of them will turn around and say, forget it, I'm not paying anymore, because, in order to get out of the house, I got to give them 120 grand, right? And they turn around and say,
in 2008, there was, let me see, the Sunday morning show. They had a lady and her husband, and they said that they got tricked into buying this house because they told them that real estate never goes down, and therefore they're not paying into a mortgage that the value of the house is not even worth what they bought. Like,
that was but number one, that goes back to what I said before about the brokers, right? Where the brokers took a beating because a lot of people did just what you're describing, right? They said the broker told them this, told them that, and this, and I don't know how that's really an excuse. But even, you're taking a calculated risk. A house is an investment, right? I mean, you shouldn't be taking the advice of a mortgage broker if, in fact, that's the case. You should be arriving at your own decisions. But whatever the case, I'm not judging. That was a large reason why. And if you look, there's this really strong probability that in situations like that, in this particular situation, you're going to see a lot of unwinding that way. You're also going to see a lot of unwinding that's going to transpire from older people that have equity locked up, right? And that's part of the retirement plan. And they're not going to be able to sit out another 2-3 years and lose all that equity and wait for it to come back up, right? They're going to say, man, look, if this is going to dump, I got to get out. And they're going to be flexible, and they're going to sell it because they want to get the cash, because they can't wait another 10, well, it's not going to take 15 years. But as a point of comparison, if you go back to 2008 when it dumped versus when nationwide, a lot of those properties, even the ones that recovered very, very slowly, got back up to the peak. Real estate wise, it took probably 5-6 years. And some of these older people, they don't have that ability. They have a paid off house, and that's part of the retirement project, right? That's included in how they're calculating the retirement. They can't allow it to drop 20%. That 20% on a $500,000 house is $100,000 that they got earmarked for the retirement. You're going to start seeing them unwind. You're going to see a lot of this start to happen. When right now we're still kind of in that middle area where everybody's so excited about getting the economy back on, get out of the house, right?
Yes.
That's step one. Is walking out of your door again. There are many, many more steps between walking out the door again and then where's the economy going to land, right?
Finding a job, going online.
Say that again?
I said finding a job, going online.
But it's not just that though. Think broader though. Think broader. Like, I mean, look at even some of the Fortune 500 companies that are entirely consumer driven, right?
Yes.
Entirely consumer driven. I mean, you're literally the gig economy, which is the restaurants, tourism, bars,
hotels,
bartenders, waitresses, etc. Right? People that don't necessarily. I mean, that represents 15% of our entire population, which is roughly like 50-60 million people. Right? So you basically, I mean, who knows how many of them come back? But just do the math there. I mean, that's 50-60 million people that either a large portion of them aren't going to be contributing to the economy immediately, or B, if they do come back, they're going to be getting paid less, no question, right? I don't think there's any question that they're going to be getting paid less, because unfortunately, with all this new social distancing, how on earth are we possibly going to have the same amount of tables in a restaurant? I mean, a typical restaurant packs as many tables as it can in order to turn those tables over as many times as they can, right?
Yes. That's the business model.
That's the business model, right? Because the margins are so small on the food and they're so high on the drinks, right? So when you say to them, look, I know you had 50 tables in here before, and you're barely making money, right? You have a beautiful restaurant, you make money, but you're barely covering overhead, which a lot of them do. Even the great ones, by the way, even the great restaurants they're not just minting money; they're not printing presses in the back, right? So you say to them, "Look, you have 40 tables in here now. Unfortunately, because of social distancing, because the room that we need, the government's requiring, you can only have 25 tables." That business is not going to go back, and the guy's going to be like, "I can't make money."
Yeah.
So then, what happens in that situation? Since they were forced to shut down by the government, they're being forced to make adjustments. Does the government buy the business? They're not going to do that.
Correct.
So then how many of those people don't make it back, right? And again, just to take a step further, and I don't want to go down this long hallway about this, but just think about this for a second. And I don't think we talked about this last week, but think about the airline industry. Think about the airline industry. I mean, forget about it. I mean, planes were disgusting to get into before, right?
Well, last podcast, we learned that you're a germaphobe and you hate germs.
I'm not a germaphobe, but there's a thing called, hold on for a second. There's a thing called airborne for a reason. You know what airborne is?
Yes, of course. I got some in my house.
Yeah. People, it is a very popular over-the-counter, chewable, or you could take it as a drink.
C.
Because of the fact that when you go onto a plane, it's just filthy, right?
Yes.
It's just, they're filthy. So, I mean, how's that going to survive? What's that going to look like? Right? What's that going to look like? And I mean, first you got to get somebody in a plane, but that's a huge contributor to our economy, right?
Yes.
The people that work in the airlines, right? And the planes and stuff like that. So I'm saying there's just going to be a lot of fallout. It's going to take a lot of time to reset a new norm. And once that new norm gets set, then asset prices will start to stabilize and you'll start to see a push up. It's just going to take time for that to happen. And while
guys,
that's going on,
this is not no doom and gloom channel, okay? This is strictly what we see from the past. John has a lot of experience. He's also a real estate investor, so he's not doom and glooming anything. There's still
because the reality is that there's going to be a lot of opportunity, right? I mean, I'm just trying to prepare people because the reality is that I'm trying to tell people, listen, don't buy right now because you're effectively still buying at the top. I'll give you an example. When back in 2008 when the market dumped, some of the areas that fell the worst and the first, because they were the first ones to get bailed out, were Florida, South Florida, Arizona,
yes,
Vegas, et cetera, right?
Yes.
So they were the ones that dumped first. So, I was building at this time, I was building a lot of houses in Philadelphia as, one of the things that I was obviously doing as well as this. And I found a property down in Florida that I had my eye on. They originally marketed it at $350. It dropped down to like $250, and I'm like, oh man, it's great. And it was, it was early sledding, right? It was like 2009, something like that. I feel like, and so I bought it, right? And I got it for like $250, which I thought was a steal, right? I mean, steal. And I obviously, I think it was 2009 I bought it. The market in Florida didn't bottom till 2011. They were trying to sell the same place I bought at $250 for $90,000.
What? It went down that much?
It went down that much between 2009 and 11. Now I still own it now, so I mean it's corrected all the way back up, and obviously then some. But at the same time, the point I'm trying to make is the reason I'm trying to be clear about people is that I want to give them the right understanding. Just because you see a very slight deal now, and you don't do this for a living. Even if you do this for a living, you shouldn't be buying right now anyway because there's going to be so many opportunities. But I'm just trying to tell people, just digest be ready for what's going to happen, be prepared, and be ready to buy. That's what it's all about. I mean, take advantage of the opportunities. And if we're giving you the proper information, then you'll know when the right time to jump in is, right? You'll start to see asset prices stabilize. You'll start to see the economy start to level off. And it's not going to happen in 1 month. We haven't even gotten out of the house yet. So to think you're going to find a deal today, we haven't even seen what that new norm is yet. We haven't seen first of all, we haven't even heard of a real plan on how this economy is going to start back up again, right? How people are going to get out of the house. So how on earth are you going to be able to try and make a determination on how, in a positive way on how we're going to recover as an economy? But I think it just with so much uncertainty, I think it's safe to say it's going to take some time. And as a result of that, you're going to see asset prices revalue, and there's going to be tons of opportunities. So no, this isn't about doom and gloom, but it's also about being accurate, right?
Correct.
I mean, if you go back to, and I don't mean to keep saying this, but if you go back to the original podcast when we started this coronavirus till now, there's not a lot of inconsistencies in anything I've said since we started till now. you look back at it, a lot of them are spot on, and fact check anything that I say. And the reality is, there's a strong possibility and probability you can actually see it play out the way I'm describing. So I'm not trying to be negative. I'm not trying to be over negative. I'm just trying to set an expectation so that people know what to expect. But to answer, and I got a long tirade here, but to answer the original question, there's always going to, banks, that's how they make money. They're not going to literally close down. They make money off of lending money, right? I mean, it's the only way they make money. So if they can't shut down and clamp up entirely. So people that look low risk are people they're going to lend to, right? If you come in over leveraged, if you come in with alternative credit, if you have any hair on your situation, they're going to pick it apart and it's going to be a problem. So there's always time to get your stuff cleaned up. There's always time to get it nice and packaged. There's always going to be lenders that are going to lend money because that's the only way they keep the lights on, right? So the opportunities will definitely present themselves over the course of the time, though. And there's going to be a lot of opportunities, probably in every neighborhood. I mean, I think in this situation where there's not just a certain geographic location that's going to get impacted by this, it's going to be, I mean, obviously some areas are going to get hit more than others, but every area is going to feel it to a certain extent in one way or another.
Okay. All right, cool. So that's, are you there, John?
Yeah, I'm here.
Okay, good. So that's real estate. We got into it. That's why these podcasts could be so long, because we have to explain something and then give the thought of it. And that's why the question can be prolonged. Anyways, I got a question from the One Genesis project. What is the best site to use right now? Will Identity IQ be the one to use?
Identity IQ is a good site. I mean, I don't have anything wrong with Identity IQ. I personally, I like experience scoring model. I feel as though compared to a lot of them, they're probably the closest correlating scoring model than you'd see on a traditional poll. I think Identity IQ is good, though. I do think, I mean, if I had my primary pick, Experian, but Identity IQ is not, I mean, I think they're a good site, and I think their scores are good. The formula that they utilize is also good. So, yeah, I mean, and I know they offer a free trial.
And you can update your 3 bureaus on that site, too, we could see.
Yeah.
And exactly. It's easily read. You can understand, too. It's not, when you look at the reports, you see all 3 bureaus on one page, and you see what you have, names, addresses, and all that stuff.
Yeah, they're a good site, though. I mean, there's some that I'm just not great fans of, but I mean, I think a lot of people flock to that, which I like that site. A lot of people, the Experience site's also a good site too, though. So either one, I think, are good. Excuse me, and they both offer free options. So.
Okay, still a real estate question from Leslie Jones. What does the jumbo loan amount start at? So I told her it depends on what area of the country you are at.
No. You're confusing, because FHA is the limits are determined county by county, right? But the jumbo is not. The jumbo is determined anything over the conventional cutoff limit is 5.25, I believe, right now.
5.25. So it's $525,000.
Right. So anything over, I believe it's 5.25, but anything over 5.25 is considered a jumbo loan. So if you finance $540,000, you'd have to take a jumbo loan out because you'd max out at 5.25. But let's just say you're buying it for $540, right? And you put 5% down, then effectively your loan amount's going to be, $515. So you would still stay under. So it would really apply in situations where you're getting north of $550, $560 if you're only putting 5% down, and probably north of $625 if you put 10% down. But that's where it would kick in. Anything north of the conventional loan limit is where a jumbo loan starts to kick in.
Okay, I thought it was because they said some parts here in New Jersey or California, FHA may go up to 5 something.
No. That's for sure. That's FHA, though. It's a county by county situation, and it's based on cost of living. So areas of New York, it's significantly higher. Areas of California, it's significantly higher. Parts of the Washington, D.C. area, they can get significantly higher.
Well, she's in Northern Virginia, suburb of Washington, D.C.
If it's like Prince George's is a high one. I'm trying to think what are some other high ones over there. I'm familiar with that area. Their FHA limits are pretty high over there in certain parts adjoining D.C. itself. So chances are, I think I think there's a Frederick County, I think that's another high one. I know Prince George's. I think Fredericks County is another one that's pretty high. I mean, when I say pretty high, I mean I think their loan limit is like $600,000-$700,000 on FHA. So, and California gets up to close to $1 million. Certain counties in California. So, I mean, it obviously pays in those situations for the money down and the flexibility you get on the seller concessions to go FHA. I mean, you are getting hit on the PMI side of things, but I mean, you kind of have to do a cost analysis there just to make sure for each individual person.
Okay, cool. Let me see. Way better. But does that mean there will be opportunities, okay, with lenders? Can people still now, basically, am I too late? My FICO Experian. Okay, hold on. Some people want some bad. Okay, hold on, John. Good evening. Drop to stimulate. Okay. Drop to stimulate. Okay, John is on. Spot on. Okay, the housing crash is inevitable. 2008 all over again. This sounds like 2008 again. Overpriced assets. Some people want this home so bad, do not pay attention when it peaked. Okay, for sure. For people who are looking to buy, should we hold off for a little? That's Joshua Cuevas who asked that question.
I'm telling every client of ours to hold off. Yeah, because what's the downside? All right, what's the downside? Play the worst case scenario. Worst case scenario, we come out 3 months and you wake up in 3 months to when the economy comes back full hill, 3, 4, 5 months, whatever it is, and that house is still for sale at the same price. Your worst case scenario, you waited 3 months because nobody's buying. I mean, there's a true no demand issue right now. There's no demand, and the supply is cut back. A lot of people pulled their houses off the market as a result of the situation because the listings get stale. So if somebody did have the intestinal fortitude to list the entire time and they're waiting, your worst case scenario is going to be at the same price. They're not going to raise the price, right?
Correct.
But your best case scenario is that same house is probably going to get chopped over the course of time, probably 15, 20%. Depending on the area and how overpriced it was and how frothy it was, it could be even more than that. In all likelihood, over the course of time, as this unwinds, it could definitely, depending on the area, because each area is specific and each area moves in different ways. But yeah, for sure, it could definitely wait. There's absolutely no downside. The downside is that somebody comes in right now and buys, and that house from underneath you, and I promise you there will be plenty of opportunities to find another one over the course of time, right? So I would absolutely advise to wait for all the reasons I described earlier. Because I think, and we've said this in previous podcasts, for people that are only using your house for a primary residence, and this is you just want to make sure that you get the house that you want. There's going to be opportunities to get that house you've always wanted, and the kicker is that you're going to be able to buy it at a price where you know where it's going to get back up to eventually, right? It's eventually going to get back up to its top side. If you're planning on living there and you love the house, then you could actually, let's just say you get a 20, 30% markdown. Let's just say, go back to the example, and I talked about this before. Let's say you buy it for $500, and it was when you had your eye on it, it was too expensive. It was for sale for $500. That same house is now on the market for $380, right? Which is about 20%, 25% markdown. You buy it at $380, knowing it's going back to $550, or at least in the back of your mind, realizing at one point in time it was up there, and eventually will get back up there and exceed there because it's just the way it is with inflation over the course of time. Then you know that you're starting to build wealth there, right? So now you're into it. Let's say you put 5% down. You're into it for $360, and it's eventually it's going to get back up to $560, $500, $560, etc. That's $200,000 you built in equity. A lot of people aren't playing the game like that. Correct. And more to provide example, the people that were buying early this year, just blindly buying, unfortunately, were not thinking along those lines, right? They just wanted to get in the house. They just wanted to get the house.
Because Lola and Macho across the street bought a house, and they think because they Lola and Macho that they could go and buy anything, so they want to go and buy.
But you understand the point I'm trying to make is though that there's not enough. Even if it's your primary residence, you need to position yourself properly, right?
Correct.
Because even if you're not an investor, even if you're not somebody that does things speculatively, it's still your money you're investing in, and it's hard-earned money. So why wouldn't you want to get into a situation properly at the right price, under the right conditions, under the right terms, in the house that you're in love with? Why force it?
Correct.
You know what I mean? Why force it? Why chase it? There's no need. Trust me, we're not in an environment where you're going to have a problem having to chase. It's going to turn into a buyer's market in a blink, right? And it was already in some areas, but I mean, at the same time, it's going to turn into a buyer's market, and the kicker is going to be values are going to pull back and interest rates are going to stay low.
Yes.
Right? And you're going to be able to buy that house you always loved over the course of time as things start to pull back, and you're going to be able to borrow at 3% still, right? Because normally they move inversely, right? Typically speaking, in a normal functioning healthy market, which we're not in right now, but if we were in, when interest rates go up, that naturally and in a healthy way forces values down because people can afford less, right?
Correct.
If their borrowing cost goes up, they can afford less. The debt to income levels all stay the same. Values start to slowly draw down. And that's how our economy worked for, 50 years up until '08. And the fact of the matter is now we're sitting in a situation where they don't have the ability to raise rates for a multitude of reasons. So rates will absolutely stay low, and you're going to see asset values come down. So as a result of asset values coming down, it's going to give you the opportunity to buy your dream house at a certain period of time, still with a 3% interest rate, which I think is incredible because you lock it in for 30 years and set it and forget it at that point.
Correct. It seems so. The first gen project said, seems like a couple of months from now, it will be open season for deals. People will not be able to sustain the mortgage without jobs to pay the loan. Equals opportunities on the rise.
Yeah, I mean, I everything they just said, I think it can go, economically speaking, it can go much further than that. But I don't want to get too much depth because I don't really think it's doom and gloom. But it gets much more depth than that. I think a couple of months is early. I really do, in my opinion. But I think, a couple of months, I think that I think we'll see a flattening in real estate. We're already seeing it for obvious reasons for
Correct.
March because nobody's leaving the house. April's the same way. But you're going to start to see when people start to digest how this new economy is going to look and that it's not going to spring back like it did before, then people are going to start to panic. And you're going to see a level of panic that's going to exist in the real estate market. I'm not saying go crazy panic, but you're going to see people that are like I was explaining earlier, where they're like, okay, maybe I'm upside down, or maybe, this is going to impact my retirement, things like that. And you'll slowly start to see it moves. The real estate market moves slow, man. I mean, I have been a part of in Philadelphia in gentrifying certain neighborhoods that weren't, and I was in there early, neighborhoods like Graduate Hospital, Point Breeze. They take years to clean up. And in situations like this, it also takes years for things to unwind. Just like it did in '08. It takes years. It doesn't happen in 3 months, and it doesn't rebound in 3 months. Today they were calling on Wall Street. They don't think earnings are even going to be considered till 2021.
Oh my
They're not even going to take earnings into consideration till 2021 because they pretty much consigned the fact that this year is a lost year, and they're going to start to recalibrate going into next year. So, I mean, if you start seeing Wall Street discount that far ahead without even considering earnings into the end of this year, then that should tell you the amount of uncertainty that exists. And with that much uncertainty, obviously, it's going to be problematic. So I think everything that the last guy said is smart about capitalizing on opportunities. I just think a couple months is. I think if you buy in a couple months, it'll be early, but you may be able to get a deal in an area where it stabilizes.
Okay, so question for you. My thinking right now, prices go up because there's 5 houses in the neighborhood that sold for $350,000, and another one sold for $360,000, and another one sold for $370,000, right? So if you go and get a foreclosed home as an investor, and you go and you fix it up, will now, with what's happening right now, that people are stopping selling, but now they fix up this house to put it on the market, right? How much is that house going to be worth? Will it be worth the same as that $375,000 house that was sold or appraised for? I mean,
do you mean today?
Today, yes.
Okay, so today nobody's buying, so it's worth nothing. I mean, nobody's buying. I mean, nobody's going to come out and say, you know what, let me buy. I mean, because even the most novice of people understanding economics understand that now is with so much indecision right now, there would be no reason to buy, right? There would be no motivation to buy. If you look at some of the real estate numbers going back a month ago, you're talking about they're reporting, early March and February's numbers right now, and they're down hellaciously. That was before we've even gotten into the end of March and into April, where we're not even allowed to leave the house, right? The numbers are going to be absurd. So anybody, that's what I was saying in the previous one too, is that you're getting people that were knee deep in projects, right?
Yes.
And they're having to renegotiate with the hard money lenders,
yes,
right?
A lot.
And yeah, tons. And what happens is, and I talked about this before, is that the hard money lenders, most hard money, not all of them, but I would say a strong 70% of them are not lending entirely their own capital. Right? They're borrowing from hedge funds. They're borrowing from outside investors. As you start to see the economy pull back, it's a rush for cash. So you start to see those hedge funds. Listen, I want to start lowering my risk to you. I want to start redeeming. I want to redeem, right? Meaning they want to get some of their money back out. So then those private money lenders start squeezing. If they're playing with their own cash, that's one thing, but that's not a lot of them. And in a lot of cases, you're starting to see them squeeze. So they can't even pass along great restructuring terms to their borrowers because they don't have the ability, because they're getting squeezed by their lender, right? And the hedge funds getting squeezed by the redemptions that they are getting from their high net worth investors, right? And their institutional investors. It's all a clam down that works its way all the way down the line, right? All the way down to where you get to the individual investor who's sitting there with a property now, and he's like, again, just use an example. Let me just give you an example just so you can digest it. Let's just say in Bergen County, for argument's sake, because we talked about it earlier, the neighborhood goes for, I don't know, $750,000. A guy picks it up for $500,000 on hard money, which is not uncommon. Okay, let's just say he's paying 8%. I think it's low, but no, I'd rather use 10%. Let's use 10%. Okay. Because I think that's more stationary. Let's say it's 10% that he's using hard money, thinking he's going to get in and out. Right. So he bought in January. Was so happy with his deal, $250,000, markdown from an equity. He's paying, once he gets that full distribution of that money, which you have to assume is somewhere in February. If he's only, let's say he buys it for $5, it needs $50,000 at work, he's selling it for $750,000. Let's say $75,000 at work, he's selling it for $750,000, right? Well, once he gets that full $75,000 in the work, he's into for $5,700 or $575,000. He's paying $5,700 a month in interest. That's it. So every month that sits, and in the equation I just provided, after you pay the realtor fees, 7-8% on, $750,000, the clear on that is about, leaves you at about $690. You're into it for $575, and every month you're pumping out $5,700. So you've been to it since February, March, April, May, and you got no money coming in. All the renovation money is gone, so you can't use that to pay it, right? Now you're coming out of pocket. How many people on an investment that's doing that kind of project, which are a lot because it's overly consumed, well, it was overly consumed, are going to be able to sustain a $5,700 mortgage payment for 6 months? Oof. They're not, and it's all relative. So you can go down to the $100,000 ones too. At those kinds of interest rates, they're not meant to be sustainable. They're not meant for you to borrow for a long period of time. And what this does is it traps investors in these projects, right? And most investors are just so eager to get in. They use the hard money because it's a low hanging fruit, rather than going and getting a construction, the perm loan with a bank that's more at prime interest rates with a tick up. That they're all going to be, not all of them, but a lot of them are going to be stuck in a situation much like the FHA borrowers we talked about before, where they're going to have to carry. And if they can't carry and they can't refi, it's going to be a problem. And I know a lot of these real estate investors are using no-doc like refi options, right? They're doing like, they're trying to do rate and term, no-doc, and they can get it for like 7%.
At the least info they could show.
Right. So, and there's certain lenders that are big enough. The problem is those lenders are going to get clamped down because they're risky.
Yes.
So the ability to turn around to that lender again and keep pumping deals through them, they're going to cut back their loan to value requirement. If they were at 75, you're going to see them at 65. Correct. Right? They're not going to do any deals for the next couple months. They're going to sit and they're going to just take applications and then slow play them until they see what happens. So what I'm saying, there's a lot of this that's going to eventually unfold. It's just inevitable. It's not an opinion. It's just inevitable as things start to unwind. There's going to be an unwinding. Whenever asset prices were so frothy for such a period of time, there has to be an unwinding of all that. And the way you saw the stock market unwind, and it's still somewhat unwinding, that we saw in the course of 6, 7, 8 weeks, right, where it dropped 35%, which is insane, right? It's almost 2 recessions packaged into one, and we did it in 6, 7 weeks.
Yes.
The real estate market is going to do that a lot slower, and they move a lot slower. And the real estate market, the stock market unwound. Now it's still probably going to have more unwinding, as things start to progress because the discounts ahead. But the real estate market moves slower, and you're going to see an unwinding there, and you're going to see an unwinding. It's going to present a lot of opportunities. Like I said, it's going to be a lot of opportunities in multifamilies because it's going to start to make the cap rates more attractive because the values are going to come down. Okay. Which is going to allow a lot of people to get a lot of good opportunities there over the course of time. So, I mean, I just think there's going to be a lot of opportunity, and people should just be patient. Just be patient. I mean, there's no rush here. This is not that kind of a situation where you need to rush. I mean, it's really not. And honestly, rushing and being hasty can really be problematic. I was talking to a client that was an agent the other day he's on Long Island. He was like, we were getting on a call to talk about a situation he was ready to buy, and I kind of went into my whole thing with it. He's like, yeah, you know what, man, you're right. I'm going to hold off. Because, chances are this house, even if it doesn't, which, even if you want to play both sides, even if we don't see the kind of pullback, which we will, but if we don't, then the house will still be on the market, right? Correct. So it's going to still be there, and it's going to be there for a price almost identical to where you're at. So by being patient, you're just not boxing yourself into a corner. It's just being tactical about it.
Okay. All right, cool. That was good. Okay, so Bernardo Hernandez, he's current customer. Gizzy and John are real deal. Okay, Curtis Davis, my FICO or Experian? Curtis Davis, Experian free credit report except score. Well, yeah, that's true.
No. Experian free credit report gives you a score. The Experian free credit report 150% gives you a score. There's no doubt about that.
Okay, you heard it, Curtis. KB, is there a list with all the creditors and what they pull depending on what state you live in the country?
Okay, this is...
Wait. I know they don't always pull the same bureau depending on where you live, John.
Didn't I tell you that this would come up? It's incredible. So I want to thank. Whoever asked that question, we're not laughing.
We're not laughing at you because
this is a question we've gotten for 10 years, and it's a question that is just it's all credit bureau driven. So
credit bureau,
it's all credit board. It's all credit board driven, and it's just another ridiculous myth. So here's the reality. Okay, just so people can understand.
But
lenders,
John, the Equifax is down south, right?
I mean, their location is in Atlanta, yeah, but that has no bearing on anything. But hold on, they're in Atlanta. But hold on. So credit bureaus and creditors, their relationships are established for lanes of credit. It's not geographic. Where those bureaus are located have nothing to do with anything. If you're Chase and you're lending on a credit card, you pull one bureau. And that doesn't matter if you live in Oregon or if you live in Palm Beach, Florida, or if you live in Arizona or you live up in New Hampshire.
And this is for credit cards, right, Jay? Or anything?
This is for credit cards. Yeah, they pull. I'll go down the list. Okay. So retail banks typically most retail banks pull one bureau. And that's for credit cards. In a lot of cases, that's also for auto loans. Almost all cases. In a very unique situation, there's a particular credit card company that will pull two. They pull their standard one, and then they bring a solidifying one, and that's always the same one. And these are subprime lenders, and they do it as a solidifying to make sure that the other bureau is not showing any worse. That's very rare. But there isn't any situation where you live a certain geographic part of the country that they pull a certain bureau that they don't pull in the other bureaus. The thing that people run into, and the problem that people run into when you see this deviation where somebody's on a credit board and says, yeah, I just pulled Navy Fed and they pulled Experian, which doesn't happen, but you'll see that, right? I just went for the City Preferred Cash Card and they pulled Equifax, but on the City Preferred, rewards card, they pulled Experian. No. And the reality is what ends up happening is, let's just for argument's sake, actually, I'll just be forthright about it. City pulls Experian, okay? That is who Citi pulls. When you go for a credit card, Citi pulls Experian, period, end of story. Okay? So when you go to pull, let's just say for argument's sake, you applied to Citi, right? And you didn't use the information that Citi has on file. Let's say your name is James Jones. And you live at 123 Market Street in Philadelphia, PA 19102, right? Or 101. Let's just say, for instance, you moved and you hadn't got any new mail, opened any new credit. They're not going to update that address. So if you turn around and you apply with your new address under James Jones, and that new address is showing, for instance, Cynthia Samoa on Equifax, they're going to pull Equifax because it's going to flock to that bureau. Nothing to do with the geographic location of where you're situated at. It has to do with the information you input. Or to give you a much better analysis, let's say the guy's name is James Walter Jones, okay? And some people like using their middle name. But let's just say Experian only shows James Jones, and Equifax shows James Walter Jones. When they go to pull James Jones, they're not going to be able to pull it on Experian because, let's say Experian is James Walter Jones and Equifax is James Jones. When they go to put James Jones, they're not going to be able to pull it because they're not using the middle name. It has to read how it shows on that bureau. Now, when we go in and we remove stuff, we let the client know. That's why when we position them for funding, we let them know how it needs to read when they apply for the actual account, so that it pulls the proper bureau, the bureau that that particular creditor is intended to pull. If they can't pull that bureau, they're going to move to the next one. Now, they will pull another one, but that's not their primary one, if you understand what I'm saying. And it has nothing to do with geographic orientation or where you're located out on the planet. The reality of the situation is it's all how it's input in as far as the application is concerned, how it correlates back to the bureau that's supposed to pull, and how correct it is or incorrect it is on whether they're going to pull that particular bureau. Now, most auto loan companies only pull one bureau, almost all of them. And they're very close to the credit card companies. I mean, all of them pull one bureau. You're going to see the same thing from the auto loans. Same idea. 95% of the time, the same lender that they pull for a credit card, and it's the one bureau. You're going to see the same thing on the auto loan. Now, there are exceptions to that rule. There's certain lenders that will pull a different bureau for an auto loan because for whatever reason they have a different relationship. But that is a very unique situation, maybe 1 or 2%, and it has zero to do with where you live. Zero. Nada. Nothing at all to do with it. Okay? None at all. When it comes to the mortgage stuff, obviously that is what it is. I mean, that they're pulling all three bureaus anyway, so one has nothing to do with the other. It's really particular institutions. A lot of credit unions pull one particular bureau. A lot of retail banks pull one particular bureau. Very few lenders, a handful of lenders pull TransUnion.
But if it's a credit union and you're going for a mortgage, they're going to pull all three bureaus.
If you're going for a mortgage, but not an equity line. So if you're opening up an equity line, they'll use their primary. Does that make sense?
Okay.
So if you're opening up a home equity line of credit, or just they're going to use their primary. So if that credit union happens to pull TransUnion, and they open up your primary mortgage, yes, they're gonna use all three. But if you try to open up an equity line on the back of that 5 years later, they're just gonna pull the one, which is their primary, which in the scenario happens to be TransUnion.
Boom. Okay. Thank you, KB, for that question. I hope you got the answer for it. Okay, Mike Hawk says, how long will it take to get a loan for land after bankruptcy Chapter 7?
And now, right? I mean, you're walking into a situation where land, I mean, if you're just buying unencumbered land with no approvals, permits, etc., even zoning, or hopefully it's got utilities run to it, right? Hopefully it's roughed and ground. But if it's just raw land, nothing to it, there would be zero market for that right now. Zero. I mean, I can't even be, because if you're a bank, that's dead money, especially right now. To get a bank to come around and take you out of that. Let's just say, for argument's sake, let's play the scenario. Let's say buy a piece of raw land with nothing to it. You still have to put all the infrastructure in, meaning the water, the utilities. Then you get that done. Then you get your plans and everything approved. That's 6, 9, 12 months later. Now you want to go to a bank to get the construction portion of it. Banks aren't going to do that. So now you're sitting in a situation where that particular issuing lender that lent you on the land is now sitting in a situation where they're stuck with this. And land is not marketable unless it's entitled, meaning unless it's approved.
Correct, because you also got to do title on that land. You got to.
Well, the title will be on the purchase, but it's not the way land becomes attractive is when you develop it, right? There's a whole market for people to go in and buy large tracts of land, develop it, sell it to developers, right? Because developers are always trying to stay a step ahead, right? So, but when you're buying land and you, number one, your buyer base is almost diminished entirely. But more importantly, if you're dealing in a situation where the lending base to get you out of that has diminished entirely, I would venture to guess that the loan to value on that, I know most banks will do like a 60% loan to value on raw land. I would bet it cuts back to 20, meaning you have to come up with like 60 or 70% of it. And honestly, at that point, you might as well just finance it, ask the seller to come up with a seller second on the difference if you're going to come up with that much. As far as a credit is concerned, to answer your question, just in case you find a lender that will do it under better circumstances, what I think will be tough, it would be really tough because, number one, it's already a tough sell to begin with. It's an even tougher sell in this market. But if you're going to come in without getting your credit clean, with hair on your file, like you have a BK and a number of negative accounts included in it, I think you're going to have a lot of resistance, as is in for a multitude of reasons. It can be. I mean, look, it's just not. It wouldn't be. I mean, in a de-risking environment, because that's effectively what we're in from a lending perspective. They're all de-risking. Why you're seeing Chase say they're not lending on businesses right now, and they're raising the requirements on lending. They're basically they're trying to de-risk. They're taking on a lot of risk here with these PPP loans, and as a result, they're trying to de-risk in other areas, right? And one of those areas where they can loosen their risk would be obviously things like this. A lot of lenders aren't even really that big into to begin with because of the risk associated with them if they're not already approved. So I think it would be tough in any instance that we try to work it out.
So clean your credit, and on top of that, don't think about that right now. Don't think about buying land.
Yeah, not only that, but I got to be honest with you. I mean, if the expectation, which I think is right, is that values are going to drop exponentially over the next 6 to 9 months, imagine what that land is going to do. It's effectively, if there's no entitlements and no infrastructure and nothing, it's worthless. I mean, there's an intrinsic value, right? Like there's a true value based on like price per acre, but any premium that was there previously is going to be gone. So what they're going to basically work off a price per acre in almost a stale market, and that number is going to probably be exponentially less than where it was at 4 months ago, right? Or 3 months ago, depending on the area that they're in. So I would just sit tight.
Sit tight and work on your credit.
Definitely work on your credit because, I mean, if you got a 13 and some other stuff in there, we're definitely sliding into an environment of de-risking. It would probably make a lot of sense whether you use us or a different company.
Okay. All right. So another question. Jay Brown, who has been our customer like 3 times. What's up, Jay? He just gave us a shout out. He says, can you use your VA purchase home as an income property?
No. I mean, down the line, maybe, but not on the purchase.
What do you mean down the line?
Like, let's just say, for argument's sake, he lives there for a year and has to relocate. Doesn't mean you have to sell the property. There's no stipulations in the VA that I'm aware of that say you have to sell it, right? Yeah. So effectively, if you don't want to sell it or you're unable to sell it, then you can rent it, right? Nothing they can do about that. They can't force your hand, right? So in that instance, then indirectly, yeah, you can, but I mean, they go through a lot of procedure nowadays to eliminate using FHA loans, and which is technically a primary residence loan, from being able to utilize that for investment stuff like that. And I'm sure VA is almost identical, especially given the fact that VA you can 100% finance it. So,
can you get a property VA that's like a 3 or 4 family?
No, I'm not as versed because we don't do a ton of VA related stuff. So okay. I'm not as versed on VA as I would be every other mortgage product there is. So I don't know 100% if you can do the multifamily. My guess is FHA's limit is you can do a 1 to 4 family and live in one and rent out the other 3. I don't know if VA offers that. That's what FHA offers. And you can still do it as a primary, but I don't know if VA offers the same thing. And I don't think they do because it's a unique program. It's very unique. So in favor of the veterans, which it should be, right? It absolutely should be. But it's very accommodating. I just don't know what that limit would be, so I can't answer that.
Okay. All right, cool, Jay. Okay. Mbelamuka says, keeping up with the Joneses, live within your means. That's right. Okay, EA says, this guy is legit. If you need your credit fixed, please call him. You won't be disappointed. Thank you very much, EA. Curtis Davis. Marcus Smith, what to do when Experian won't have a report, John?
Meaning,
what do you do when Experian doesn't have a report for you?
Right. No, I mean, I understood how you said the question.
Okay.
Sometimes there's some confusion about this. So is he saying that he's trying to sign up with Experian and they're not producing a report? Because I can go back to what I said earlier about the credit cards and what banks pull with bureaus. It can be all contingent upon the information that you're inputting and how it may conflict with what they're actually reporting. Because a lot of people aren't aware how the information reports on the bureau specifically. So if you're signing up with no address, if you have a thin file and only 1 or 2 addresses, you're using a third. If your name is spelled a different way, if you have a unique name that somehow is if there's any number of things that could prevent it. Everybody has a file with.
So they will need to eventually call them up, and then they'll ask for their ID, utility bill, and SSN?
What's going to initially happen is they'll call up and they'll ask them security questions in an effort to try and get it released. And if they can't, then what they'll do is they'll mail them a copy of the report to the address that they have on file, because that's the last known address they have for the individual. And then that would be their opportunity to find out what information they were wrong about or where they missed, and then they can try and reinsert it. But that's normally the procedure for them.
Okay. All right, cool. So Marcus Smith. Okay, that was Marcus Smith. Andrew Johnson, what today purchased our professional do-it-yourself credit repair system. Congratulations to Andrew. He's a bus driver and also does credit repair on the side, but he gets a lot of knowledge from our videos and has a lot of customers already. So congratulations, Andrew. He has a question. So will credit card companies still get high credit limits when applying, when we talked about this market downturn, John?
Yeah, so you're just going to see them de-risk from some of the files that may have been question marks, right? The ones that don't have any hair on them or have existing relationships with that particular credit card company, historical existing relationships with those credit card companies. No, they're not. Why would they stop? I mean, they're in the business to make money, right? In certain instances, when the economy contracts, they have to be more particular with who they're lending money to, though, right? Rather than just peppering the country and trying to expand their balance sheet. When the economy contracts, they start to contract. So people they have exposure to, they're going to assess that exposure and potentially lend more, because either they have a good relationship with that person or that person's coming to them with their own style of financials, right? Or a good situation that they may want to work with. So you're not going to see them shut down. You're just going to see them scale back from the riskier side of things. And meaning, understand, credit card banks and credit unions make a lot of money on credit cards, make a lot of money on auto loans.
Correct. Those
rates and those terms are not going to change. Right? They're not driven by the Fed. They're not like mortgages. They're not like, they're going to still work their float on auto loans. They're still going to work their float on the credit cards. You're still going to see them reasonably high. So, I mean, they're still making a lot of money. They're still going to they're still going to lend out aggressively. They're just not going to. That's why it's important if you're going. People are going to see this anyway, quite honestly, when they start to apply, and they're going to start to see the resistance, whereas they may have not seen it before, right? But the banks are just going to be more picky. And the way to work around that, around those algorithms adjusting, is just going to be to make sure that your stuff looks good. You can't be maxed out. You got to have your usage within the range, which is at least 30% or down. I'm sure anybody that's pushing 50 is going to get bumped off. So the point I'm trying to make is things like that may have squeezed in before. You're not going to get that squeezed in over the course of time.
Andrew, definitely purchase our $99 credit card funding system. I probably think you purchased it already, but it goes into detail on what the banks, it goes into the equation. Because remember, right, John, your credit score gets you in the door, and what gets you approved is your income minus your expenses. So that's what John is talking about, is making sure that whatever you're paying on right now, you're not maxed out. Be 20%, 10% of the credit utilization. Don't be at 50% and try and go out there and get new credit, because that's what's going to get fishy. The lower your credit utilization, the better it is for you.
Yeah, I mean, you're even going to see. I mean, you'll start to see some of the alternative lenders start to pull back a little bit, right?
Even with that, John, even with your income minus your expenses, even if you show that you have a job and you can sustain this new credit.
Yeah. So I mean, like I said, look, again, these businesses are predicated on lending money. So I don't want to make it seem like they're going to cut their money supply by 50%. That's not the case.
Okay.
But you are going to see a contraction. And it's not going to be as easy to get. It's just that simple. It's not going to be as easy as it was. They're still going to want to lend to good borrowers, right?
Correct.
Not going to cut that back. They're going to cut back the risky borrowers. Everybody knows who the risky borrowers are. The people that are risky borrowers know the risky borrowers, right? Correct. So, I mean, it's people that are pushing their limits. They're 50% or more in some cases. They might have a late here, a late there. They might have any number of situations, right, that are transpiring that are sitting on their credit. they may not be somebody that's had problems for the last 4 or 5 years because they've still been able to acquiesce Capital One card or just getting rated on their auto loan or their credit card or things like that, right? Where when they really should be getting a 3% rate, they're getting an 8. They're fine with 8 because they got the car they wanted and they can afford it, right? These are the risky borrowers I'm talking about. It's not necessarily that they're bad borrowers; they're just more risk. And if let's say there's 350 million people in this country, and 30% of them happen to be looked at, which I think is a small number, but let's just say happen to be looked at as risky borrowers. That's still a lot of money for the other 70%, right? So I'm just saying that it doesn't mean that they're going to stop lending. They're just going to be more calculated in the lending. So to answer his question, there's still going to be high limits. If you have high limits, they're still going to be there. They're not going to cut back on their exposure to you unless they have a reason to, right? Correct. Unless you give them a reason to. If you're still doing business as usual and you're keeping your file clean and you're keeping your ratios where they need to be, there would be no reason because, I just put myself in the position of a lender. Why would you, in a down market, why would you want to cut off the supply to a good borrower? It wouldn't make any sense, especially when you're in the business of earning interest. So they're definitely going to keep lending. It's just anybody that has had difficulty, in getting, financing of any kind, if you don't do anything with your situation, it's going to get tougher.
John, do these banks talk to each other? Like if you have a late payment and then that credit card company lowers your credit limit, does another credit card follow and says we're going to lower your credit limit?
It's triggered by the report. You understand what I mean? So yes. let's just say for argument's sake, somebody goes late on their Capital One card, right? And that limit's $4,000. They got a $1,500 Capital Credit One and a $1,000 First Premier, right? And now they're late. They go late on their Capital One, which is their lives limit, and they're late on their car. There's obviously not a lot of relationship there. If the lender Capital One's going to turn around and say, we're dropping your limit from $5,000 down to $2,500, but you could see that though. Just to be clear, that's actually good to bring up because you could actually see that happen. There's going to be a lot less flexibility over the course of time on things like that, and you could see reducing exposure the minute you may go late, right? But to answer your original question, what'll happen is when those lates show up, you'll see the original creditor in certain instances cut back, and then the other ones will follow because they got the same alert. They use similar systems. They're not intercommunicating, but they use, like I've said before, they all use similar algorithms, right?
Wow.
In approving certain amounts and monitoring the report, whether it be early warning or it be any number of other systems that they use. They all use the same system, so they're getting triggered the same way. They're not. Other than check systems, I know early warning is a system that is interbureau too. But at the same time, it's more related to the activity itself that you can identify on the report that's substantiating. Right?
Is that on when you get a new credit card and you get the new credit card that's attached, taped to the sheet, and in the back of the sheet there's this little pamphlet that talks about your interest rates and all that stuff. Is that stuff written in there that they could decrease your limit?
They reserve that right at any point in time. That goes for, and honestly, that goes for a line of credit, that goes for a home equity line of credit, that goes for an unsecured line of credit, business, personal. That happened in spades back in 2008 because that's why back in 2008, unsecured lines of credit were like the thing, right? Banks were lending out unsecured lines of credit, large amounts, hundreds of thousands of dollars to people that had absolutely no business getting them, right?
Yes.
So the minute that things started hitting the wall, and keep in mind, the last collapse was as a result of banks having issues, right? So that, obviously exacerbated it. So they're in a much better position now than they were then. But back then, they were cutting lines in a minute. They cut you down. If you had the room, they cut you down to your limit. If you didn't have the room, they chopped you in half. There just wasn't the tolerance for risk and any more exposure. Now, this is a little bit different, and it'll move slower because it's going to be a natural cleansing of and like I was saying before, a new norm and a repricing and a new starting point that we're going to build from once all the dust settles here. But I don't think it's going to be as aggressive as it was then. But I do think you're going to see them cut back on risk from borrowers that they maybe weren't overly enthused by.
Wow. Okay, yeah, that's a good question to ask. Okay, so Andrew Johnson also asks, also is the real estate side on the real estate side, would the bank still approve a RELOC, or I don't know if it's a HELOC, RELOC? I'm pretty sure he's tried to
Maybe
put
it just means real estate line of credit. Maybe
real
that's what he
estate
means.
line of credit since the economy is in limbo.
That's a good question too because it's in second position. I can only in that capacity. I can only work in from back what occurred in 08, 09, and they were definitely cutting back because obviously second position people are the ones that get slaughtered, right? If somebody stops paying, because the first position soaks up whatever they can get, second position barely gets anything. So I'm sure you'll see some cutting back of that. I mean, it's a very good question. I don't think if the right loan to value is in place, meaning like let's just say the house is worth $1 million and the first mortgage is $250,000. Do I think that they would lever up to 50%? Sure, because even in that case, second position is still going to get made whole and then some, right? If they got to sell it at 750, the first and second position are going to get paid off. I just don't think I think you're going to see the loan to value scale back, right? So rather than being like 90%, like it is right now, you'll probably start to see it slowly scale back, and then which will effectively lead to less options of it because most people are levered to their earlobes. So it's not going to give people the option to apply for it. So they're going to cut back. Again, it's another way of cutting back risk is lowering loan to value, right? And if you lower loan to value, you give the bank a better placement with their loan in the event that something goes left or right, which gives them more peace of mind, right? So more than likely, if it takes a long time to unwind, you'll probably see that start to scale back. The production of them start to scale back because the loan to values are going to come back, and most people don't have 30, 40, 50% equity in their property. It's just not the norm.
Okay. All right. So Mike Hawk said, okay, thank you. Sounds good. Armando Rosario, we just gave him a quote. I'm fixing my credit with you and then purchasing my house. No rush, as the guest host is saying. There shouldn't be a rush for me to purchase. Wait for the house and, most important, right price. Okay, good. Yeah. Great. Joshua Cuevas, who is our customer, we're fixing his wife's credit. GizzyCredit is bomb. My wife scored 3 weeks was low in a matter of 3 weeks, 100 points raised. Highly recommend. Thank you. Andrew Johnson said, yep, a big thanks, guys. So glad to make a lifetime investment in the credit game. Yep, I purchased the funding a minute ago too. Thanks for the help. You guys rock. Okay, cool. So Yasha Hart, which I think Yasha just sent her info for us to give her a quote. What would be the best loan or line of credit to apply for after Chapter 7 to raise your credit scores? As how soon should you apply? And how soon should you apply?
Yeah, so there's only a handful of lenders that are going to lend after a BK, especially right after, and they literally fall in like the subprime arena, which you're dealing in some of the Credit One, Capital One, First Premier, Merrick. They're kind of second chance. We're going to give you a second chance, but we're going to charge you 25% interest, 30% interest, make you feel like we're doing you a favor, but in reality, you're doing them a favor. That's about it. There's not a ton of opportunity. Now, as you start to scale further away from your Chapter 7, you'll start to see other lenders open up. But there's a giant question mark going out a couple of years about where we'll be, economically speaking, and what will happen, obviously. But I think if you're talking about right now in this moment in time, I think they would be the lenders you'd probably be isolated to as a result of how recent the BK is. Again, if you go further out, sometimes it'll open up other opportunities. That doesn't mean it opens up every lender. If you just file 7, it's going to stay on there for 10 years. And, depending on where you're at, and let's say you're 5 years into it, and you start to show pay history on the smaller ones you've opened up, it'll definitely open up other opportunities for you. They're not going to be great terms. They're not going to be great rates, but they're going to be options of credit. So you don't intend on working, if you don't intend on working on it, as far as the repair side of things, they would be the lenders. They would be the only starting point, quite honestly. There is not another starting point, and you can learn the hard way by shopping around every lender on the planet. But right now, almost every lender in this country is cutting back a tremendous amount of risk until they figure out what's going on. And given the fact that you have a situation that just transpired, I think, they would be the only option if they are an option, because I'm fairly certain that even those lenders are cutting back right now.
Yeah.
For a multitude of
You
reasons.
should hear our How to Remove Bankruptcy podcast. If you go to my channel, we talk about how you could restart your life after bankruptcy as well. But John, I think she needs credit repair no matter what.
I think going forward, I think it's inevitable. I mean, look, everybody's going to arrive at a different way, and the determination and the understanding. Everybody needs to make their own decision. But I think chances are, more than likely, she'll probably give a couple of them a shot, see that the options are likely limited, and maybe reach back out to us or some other company. Hopefully, I can get her in a position, because I think if you're really trying to establish significant amounts of credit under the right terms, et cetera, especially right now, like I've been saying this whole time, there's going to need to be a beautiful file on the table. Otherwise, you're going to start to see. And look, a lot of you are going to experience it, And if you are somebody that may be a little higher on your unsecured credit ratios or something, when you go to try and get an increase, you go to try and apply for new credit that you weren't rejected at before, you're going to start to see denials that you didn't typically see before. And it's going to be as a result of that. So you just know how to navigate when you get to that point and cut back the ratios and make the necessary adjustments, and the adjustments will put you right back in a good position.
Okay. All right, cool. So that's Josh. Yep. Andrew said real estate line of credit. Okay. Armando Rosario says, is it more difficult to get approved for a 15-year mortgage as opposed to a 30-year mortgage, John?
Only based on the debt to income, because your payment's effectively doubling, right? Because you're cutting it in half. So if you're a $100,000 mortgage at 3%, your principal and interest is going to be about $350 on a 30-year, right? On a 15-year, it's going to be about $700. So you're doubling it. So you have to be able to still cover the debt to income ratio. It's still the same amount. You're still going to, at least pre all this, the debt to income ratio was like 55% they lent up to. So you're doubling your mortgage payment, and you need to be able to squeeze it into your debt to income ratio. That would be the only squeeze. And that would be the only thing that would make it more difficult. It really depends how levered you are as a person, or how high your debt to income ratio is, to be able to see if you can fit that additional, because you're effectively making two payments when you're doing a 15. You're doubling your payment. So if you can fit that into your debt to income ratio, then no, it wouldn't be a problem. If your leverage is high, meaning the amount that you gross relative to what you have going out the door, and then the subsequent percentage there up to 55%. If you have the room, it works. If you don't, then obviously you'd have to figure out ways to squeeze it in. You can always, for the record though, if for some reason, getting in at a 30-year, and then over the course of time, you can, as you build some equity, you can always chop it down to a 15-year, right?
Correct.
So it doesn't need to be the walk-in. Also, the other thing people need to understand is you can always just make that additional payment. After you make your principal interest payment on a mortgage, anything you pay after that for that month goes entirely to principal, as long as you don't have any late fees. So if your mortgage payment is, you go a 30-year and your 30-year payment is $350, like I said, $100,000 at 3% is going to be about roughly $350. You make that monthly payment with no late fees or anything, and it's good. The 15th of that month, you want to make another payment, you can. That all goes to principal. So you don't technically need to go through the whole re-amortization of 15 years when you could just control it yourself and effectively pay the same amount. And it actually, doing it that way, actually pays it off quicker, because you're avoiding the compounding interest as a result of the 15 years. You're just paying out front for 30. So it actually moves along quicker if the goal is to pay down the mortgage. Correct.
Okay, I got someone that says, now it seems like a good time to do a credit sweep. Am I correct?
We don't use that word around here, but
the credit repair, yes, but not credit sweep. Fatha truth. We're not about that credit sweep life here. Credit sweep is known to be done with a police report, and you file an affidavit and you put that everything has been fraudulent. No,
whether it was or it wasn't. So
whether it was or it wasn't, yeah.
Now, if the broader question was just, is now a good time to get credit, without a doubt. I mean, if you're trying to position yourself properly, we talked about this 6-8 weeks ago before this really has culminated. Go back in the podcast. Our first podcast was telling everybody, this is about 6 or 7 weeks ago. Correct. Right when the first week this all started was, listen, start positioning yourself now for the opportunities that are going to present themselves over the next 6-9 months. Okay. Again, if you go back, if anybody hasn't had the time to go back and listen to them, you should really go back to at least the early ones from the coronavirus, because you'll be able to see, because these were done, like I said, 4, 5, 6 weeks, some of them 6 weeks ago, and you'll be able to see how some of the things we talked about actually materialize and have materialized week by week, right, after we've talked about them. And, it'll just give you further understanding of the knowledge that we're trying to kind of give to you guys and the accuracy of it, right? And that we're not just giving you an opinion. In a lot of cases, we're giving you reality. And the purpose of that is to try and provide you guys one particular area to get the right information, not get convoluted with a bunch of people in a credit board that may or may not have more information than you do, but present it as its fact, right? And all they do is confuse and perpetuate that confusion. So, a large part of this stuff is just to give people the right information so they can make the right decision and they can not shoot themselves in the foot,
Correct.
And that's what we're going to keep doing. That's why we like doing these, and at the same time, it educates people and all that stuff. So
one last question, Jay, because I know we both got to go. Is there, if there is a name and address associated with my SSN that is not mine, how do I remove that?
How would that happen?
How would I remove that?
No, I understood it, but how would that even happen? The only way that could happen is if you had a CPN and the CPN merged with your primary report, which I assume is probably the case. I may be wrong, but I think that's probably the case. If that is the case, and I don't want to go on too long of a tangent here, but if that is the case, because I've seen that happen, and it is a bear to try and get that stuff off, because effectively the bureaus and the creditors end up arriving at the conclusion that you've opened up a CPN with another account, and they do the merging. It's not independent from that. They're the ones that manually insert that stuff. That's not done through the algorithm. That gets done manually, because there's no way for that algorithm to tie all that together. So it's very difficult to remove. If it's from a CPN, and as a result of that, if it's not, I don't know how knowing the system as well as I know it, I don't know any other way that like if it's a completely wrong name and it's a completely wrong, Social Security numbers, additional Social Security numbers would show up on your credit report if it was somebody you applied jointly with. Like if you applied for an auto loan with your husband, their Social Security number, because that's the way the account gets submitted, is going to show up on your credit report. It just is. It doesn't mean it's yours. It just means it's an associated one, which allows for the creditors to recognize it. A totally different name. Outside of what I just described earlier, I don't see how it would be humanly possible. But if it's not what I'm describing with the CPN, then you should be able to call them and say, "Listen, it's not me." You know what I mean? Like, why is my name's James Jones? Why is Ken Williams showing up as a name? That's not me. Here's my license. Here's my ID. It was never my name. If it is a CPN scenario, then it's gonna be tough sled. It's very tough sled, and they do that for a reason. So you would know where you fall in that situation. I don't know particularly.
Correct. So the Genesis project also says, how does proper personal credit position you for business credit? Do you help in this area?
Proper personal credit positions you on the business side, because once people come to the realization, we talked about this too in a previous cast, but once people come to the realization that there is no such thing as no PG loans for startups, right? Like real money. I'm not talking about a Kinko's card or a gas card. I'm talking about like you wanting to actually use the money and be able to use it for your business. You have to use your personal credit. You have to personally guarantee that. Right now, I'm not saying over the course of time, if you have a functioning business and you have history and you got an Experian business score, all the business scores are where they need, and you showed you be able to do it. They absolutely do non-PG business loans and business lines. That happens, but that happens after you've shown legitimately, not building up, 30-day vendor points with Granger on DMB, right? Not having the guy that painted your house send you 30-day terms to DMB. It doesn't work like that. That's not reality. And I know that's what's being told on the internet, but people unfortunately always have to learn the hard way. And then they find out later that's not the case. So to answer the question, you have to use your personal credit. And on the business side, they pull your personal credit, and you need to look just as beautiful as you would if you ran it in your own name. So it's not like just because it's going in the business name, if your financials look great on the business side, but you look like a train wreck on the personal side, they're going to lend to you in the business name. It doesn't work like that. In the early days, in the early trucking of a business, this is just a brass tacks. In the early days of a business, you're basically guaranteeing your business. So they're looking at your personal financials as a large majority of the process, right? And on the business credit card side of things, they're not asking for financials, right? They're basically going by what you state the income is, which means they're putting even more emphasis on your personal credit report, right? So it's absolutely mandatory in the early trucking of a business. If your only options are business credit cards or business loans, you have to personally guarantee it, and it has to look good, and your ratios have to be in line too, meaning debt to income ratios, your credit ratios, all that stuff. And again, going forward, but not repeating myself, going forward, that's going to tighten up as well. Just look at JP Morgan. Last Thursday, JP Morgan Chase said they're shutting down all their business lending for the foreseeable future. That means zero business lending. So just to answer the question, yes, you absolutely need to have your personal credit looking beautiful if you're trying to get business funding of any real amount. And I'm not talking about, just let me be clear. When I say business funding, I'm talking about real sustainable stuff. I'm not talking about cash advances.
Correct.
I'm not talking about cabbage, which is a cash advance. I'm talking about real lines. Okay, ones that are sustainable, that don't have you in a chokehold with their foot on your throat, like stuff that you don't have to pay back in 15 minutes, right? I'm talking about real lines that you can sustain, you can grow your business, you can actually utilize. That's what I'm describing. Any of the other stuff I'm not describing.
Okay, John, does the credit bureaus have to follow the 30-day to 45-day response period?
Do they have to?
Yeah, Marcus Smith just says, does the credit bureaus have to follow the 30 to 45-day response period?
Yeah, I mean, it's 30 typically. I know they have an extenuating circumstance clause that they can exercise where it's like an extra 10 or 15 days. But, I mean, 99.999% of the time you'll see it done within 30. Yeah, for sure. I mean, it's technically, it's a law, right? I mean, it's in the Fair Credit Reporting Act. It's a legitimate law. It's not just speculation.
But when we dispute online, I mean, we get results back in an hour, remember?
No, for sure. There's some, you can. But I think he meant like in a worst case scenario. That's how I interpreted the question. In a worst case scenario, do they have to get it in by 30 to 45 days? Like when we do it online, even when we mail sometimes, if we have to upload it, I mean, we'll get them back in 2 weeks. I've had disputes. There's only like one or two accounts who've gotten them back the same day.
Yes.
So I mean, it's not. If the question is, do they all take 30, 45? No, absolutely not. Normally, if we're doing them online, the ones that have the most accounts push to the closer to the 30 days because it takes longer for them to get all the responses back through eOscar from all the creditors, make the determination, and spit out the results.
Okay.
But no, it's not. It's not.
Okay, John. So in conclusion, mortgages, they do all three bureaus. Car loans typically pull one, and credit card companies typically pull one bureau.
Yes, correct. Yeah, for most part. But honestly, there's a couple that pull two on the credit card side. They're mostly the subprime ones, and they do that because they're subprime, and they're borrowers. They just need a little more levity. But 98% of the time, you're seeing one bureau pulled. There's the ones I'm describing an exception.
Okay. All right, John. So I think we are done today's podcast. A lot of people contributed. Thank you so much. About an hour, 47 minutes right now. Remember, I just put out a credit repair results video. If you don't follow me on Instagram, I post all my results video there. So now I combine videos and I posted them on a YouTube video. It's called Pandemic Credit Repair Results. Okay. Removing any type of negative account. Make sure you check it out. Make sure you like the video and share it. If you know a friend who's going through some hard times with their credit, you already know we've been doing this 10 years plus. On top of that, we give you free education, let you know how you could do things so you can better position yourself to do what you want to do with your credit. Again, I want to say thank you to John. Everybody clap your hands for John. And John, it's been a busy day, and I think we're going to be busier too.
All right. Sounds good, guys.
All right, John. Thank you so much.
All right, bye.
Bye-bye. So, yeah, my people, I'm sorry for the little robotic, sketchy on Facebook. It's all messed up. On YouTube, I know the voice it's coming along perfect, but I see myself as a robot. So I'm sorry about that. I want to apologize for the low quality of the video. I'm working on getting a new computer, and it should be here soon. I also will have a green screen so you could be better educated and have more of an enjoyable experience when we talk to you guys. So definitely thank you so much for all you who log on. Thank you for Andrew, who purchased our professional do-it-yourself credit repair system. And of course, you know, if you watch us and you do credit repair, I suggest you keep listening to us because we know what's going on. We do this 24/7, 7 days a week, and we love helping people out. So again, thank you so much. The First Gen Project, Marcus Smith, during this pandemic. Yep. Good stuff. Jay, thank you so much. Oh, can you hit that like button? We'll definitely appreciate you. Thank you much. Bendiciones, like I say. See you later.